Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, just look at the tape from Friday. That's January 23rd, 2026. Just look at it. Air WYI Inc., ticker YYAI, closed at $1.54. That is a single session gain of 31.62%. But, if you're just looking at the price, you are missing the actual story. The story is in the volume. We saw, 13.57 million shares trade hands? That's a structural breakout. We're talking 2.6 times the 30-day average. Something massive has shifted here.
The volume is undeniable. I'm not going to argue with the tape. The liquidity was there. But the question we have to answer isn't, did it trade? It's, what exactly are people buying? Because when I look at this chart, I see a company posing a very, very dangerous question to investors. Is this the ultimate deep value play, a microcap pivoting into, the two hottest sectors on Earth, AI, dating, and RWA tokenization? Or are we looking at a classic textbook China hustle?
See, you're already framing it with skepticism dialed up to 11.
Well,
I look at that same data, and I see a massive asymmetric opportunity. I see verifiable revenue growth that the market has, frankly, completely ignored until Friday. And most importantly, and I know we're going to get into this, I see insider buying on a scale that you almost never see. Management puts millions of their own dollars on the table. That's not a hustle. That is conviction.
Conviction can be expensive if it's misplaced. But let's strip away the narrative for a second and look at the actual business. You mentioned the pivot. The market's been treating this company like a shell for a long time. You're arguing that phase is over?
Oh, it is absolutely over. This is not a narrative play anymore. Look at the numbers for the 9 months ended January 31st, 2025. Revenue is up 581% year over year to nearly $9.8 million. That is a 6x increase. This isn't smoke and mirrors. This is an acquisition of YYAI Enterprise Management. They bought a business, they integrated it, and it's spitting out royalty income. You have a tech company growing at over 500% that, before this breakout, was trading at a PE of roughly 10, maybe even lower. In a market where AI stocks are at 50 times sales, a 10 times earnings multiple on this kind of growth it's absurdly cheap.
Okay, stop right there. You're doing the price to earnings thing. 10x earnings sounds great on a screener, but earnings are an accounting construct. I don't care about net income on a press release. I care about cash. And when I look at the cash flow statement, the story completely falls apart. You cited the revenue jump, great, but their operating cash flow is a negative $30.81 million.
You're ignoring the investment phase.
No, I'm looking at the reality of the business operations. How do you have positive net income but burn $30 million in operations? That disconnect is massive. It suggests that the income you're celebrating is driven by non-cash items, probably unrealized gains on their crypto or something. They are paper-rich and cash-poor. That is a dangerous place to be.
It's a growth phase. You expect cash burn when a company is pivoting this hard. But let's talk about that cash-poor comment. They reported $132 million in cash and short-term investments. That is a fortress balance sheet for a company with this market cap.
is it a fortress or is it a house of cards? Because in a normal company, $132 million in cash means T-bills, money markets, safety. Here, that capital includes $30 million in Solana tokens. It includes promises related to a joint venture. These are not stable US dollars. They are highly volatile crypto assets. If Solana takes a 20% haircut, which, it does on a random Tuesday, that fortress balance sheet shrinks immediately.
And if Solana doubles, which is exactly what the market is pricing in right now. But hold on, I can't let you gloss over the strongest signal in this entire thesis. You can debate the cash flow, you can debate the token volatility, but you cannot debate what Chairman Hong-Yu Zhou did.
The open market purchase.
The massive open market purchase. On January 21st, literally days before this volume explosion, the chairman executed an open market purchase of 4.2 million shares. He didn't get these as options. He didn't get them as a grant. He spent $5.77 million of his own cash to buy stock at an average of $137.
It's a bold move, I'll give you that.
It's more than bold. It's a line in the sand. There's an old adage on Wall Street that is true every single time. Insiders sell for a dozen reasons: tax planning, divorce, buying a yacht. But they buy for only one reason. They think the stock is going up. You do not drop nearly $6 million into a China hustle. You just don't. That buy sets a hard valuation floor because he knows what's coming.
It sets a floor on sentiment, sure. It signals that he believes in it. But history is littered with CEOs who doubled down on a sinking ship. And let's look at the structure he's buying into. This just screams China hustle. You have a former U.S. shell company, Slinger Bag of all things, a tennis bag company, acquiring a Chinese entity, changing auditors, and suddenly pivoting to every buzzword in the dictionary. AI? Check. Metaverse? Check. RWA? Check. It's a buzzword salad.
You call it a salad, I call it a diversified conglomerate.
It looks like a lack of focus. Their core plan is to tokenize U.S. equities for an unlicensed exchange. That is not a business plan. That's a regulatory target. The SEC has been crystal clear about this. You can't just tokenize a share of Apple and trade it on some platform that doesn't have a broker-dealer license.
You're conflating the ambition with the current reality. Let's dig into the business itself. You're skeptical of the business mix. But look at Yunyu. This is the love and marriage business. It's not just some Tinder clone. It's an online to offline model. They have physical hand-in-hand stores.
Physical stores? In 2026? That sounds like high overhead, not high tech.
In the Asian matchmaking market, trust is the currency. The physical stores provide that trust layer. But the tech stack behind it is real industrial-grade AI. They're not running simple matching scripts. They've integrated Baidu's Wenxinyan LLM. That is the cutting edge of Chinese language models. And frankly, the validation isn't coming from me, it's coming from their partners. Look at the agency deal with TikTok with ByteDance.
The TikTok connection is flashy, I admit.
It's more than flashy. They secured an agency deal to expand into the MENA region. You do not get a deal with ByteDance to represent them in a massive growth market if you're just some shell company. That proves management has high-level access to the global tech ecosystem. You can't fake that with a press release.
Okay, let's pull on that thread. The TikTok deal is interesting, but it feels like a distraction from the elephant in the room. You have this marriage matchmaking business on one side and this crypto exchange thesis on the other. Where's the synergy? It looks like a conglomerate mess designed to confuse investors. And we have to talk about the JuCoin joint venture.
The $500 million commitment, it's aggressive.
It's terrifying. Listeners need to understand what this actually is. ARWA is partnering with JuCoin to build this exchange. JuCoin, formerly Jubi, has a very sketchy reputation in the crypto space. They've been flagged by on-chain investigators. They are unlicensed. The Monetary Authority of Singapore has been tightening the noose on unlicensed operators, and JuCoin is not on their exempted list.
They're operating in a gray area, sure. That's where the growth is.
Here is the structural problem. The entire heirloom thesis relies on this partner. If JuCoin goes down, or if their domain gets seized by a regulator, or they get hacked, which happens to unregulated exchanges constantly, the entire thesis collapses to zero. You are betting the farm on a partner that wouldn't pass a basic compliance check at a U.S. bank.
It's a risk, absolutely. I'm not denying that. But that risk is exactly why the stock is trading at $1.54 and not $15. The market is discounting for that disaster scenario. But let's go back to the tech stack for a second, because you dismissed the Baidu integration. Using Baidu's Ernie bot puts them miles ahead in terms of linguistic capability in that market.
And it puts them directly in the crosshairs of the U.S. Department of Commerce. We are in a tech trade war. We have a NASDAQ-listed company, YYAI, relying on Huawei and Baidu AI models. That is a geopolitical minefield. What happens if the U.S. bans the integration of adversarial AI for listed companies? If that legislation drops, Yunyu's tech stack becomes illegal overnight.
That is a macro risk that applies to half the tech sector with China exposure. Let's move to valuation, because I think the market is mispricing this regardless of the geopolitical noise. Let's look at the comps. I'm looking at DeFi Technologies, ticker DEFT.
Right, the darling of the crypto equity space right now.
Exactly. And look at the disparity. DFT trades at roughly 4.17 times sales, YYAI is trading at 1.73 times sales. That is a massive gap. If AirWA simply re-rates to the peer average, not even a premium, just the average, you are looking at more than 100% upside from here. A $120 million market cap is not unreasonable for these growth numbers. Right now, the market is pricing YYAI like it's AGM Group, distressed crypto mining hardware.
There is a very specific reason for that discount. It's not an oversight, it's a risk premium. You compare them to Def Technologies. I'd compare them to WonderFi. WonderFi is regulated. They went out and bought licensed exchanges. That costs money. AirWA is attempting a regulatory shortcut by using JuCoin offshore,
Which allows them to move faster. Speed is a feature in crypto.
Speed kills if you hit a wall. And I want to go back to that balance sheet. You keep calling it a fortress, 132 million in assets. But when you peel it back, how much of that is liquid USD? It's likely largely Solana tokens and these JV promises. If Solana drops 50% and we know crypto winters happen fast, their strong balance sheet evaporates. This is a high-risk crypto holding company masquerading as a stable tech stock.
Well, if we are talking about crypto movements, we have to talk about the market mechanics and the correlation with Polymarket. This is where the alpha is right now. This is why the stock broke out.
Okay, explain the connection for the listeners.
It's a fascinating arbitrage. The company holds $30 million in Solana. Now, there is no spot Solana ETF in the US yet. But on polymarket.com, the odds for a spot Solana ETF approval in 2026 jumped from like 45% to over 75% in late January.
So the market thinks approval is imminent.
Exactly. And since traders can't buy a Solana ETF yet, they are looking for proxies. They are looking for anything listed on a major exchange that holds Solana. YYAI is acting as a backdoor ETF. When those Polymarket odds rise, the implied value of the Solana on their balance sheet rises, and the stock follows. It's a proxy trade.
So it's a tracking stock?
It's a leveraged play. And look at the beta. The 60-month beta is negative 1.97.
Which is bizarre.
It's not bizarre, it's beautiful. A negative beta of almost 2 means this stock effectively hates the S&P 500. When the broader market crashes, this thing tends to rip. It's decoupled from systemic equity risk. For a portfolio manager who is terrified of a recession, holding YYAI is a unique hedge. It moves on idiosyncratic crypto news, not on what the Fed does.
Okay, I see the correlation, and I get the backdoor ETF narrative. But I interpret the market mechanics very differently. I'm looking at the short interest and the dark pool data. And what I see there, it scares me. The cost to borrow shares of YYAI is around 54%.
That is incredibly high. That's a squeeze waiting to happen.
It is high. It means short sellers are paying annualized interest of 54% just to keep their bet open. Now, you say short squeeze, and you'd be right about the mechanics, but flip that coin. That high fee tells me that smart money is betting heavily that this goes to zero. They are so confident it's going to crash that they are willing to burn 54% a year just to wait for it.
But they are trapped now. That volume on Friday, that was the sound of the trap snapping shut.
For now, but look at the dark pool volume. It dropped 70% leading up to that Friday close. Usually, institutionals trade in the dark pools to hide their hand. When that dark volume dries up, it's like the ocean receding before a tsunami. It means institutional suppression is lifting.
Which allows the price to fly.
It forces the volume onto the lit exchanges, yes. That explains the volatility. But it creates a very fragile order book. When the big institutional liquidity steps away, you get air pockets. The stock can melt up, which we saw Friday, but it can also air pocket down just as fast. There is no floor of institutional support underneath this. It's all retail momentum.
I view that dark pool drop differently. I think the institutions are stepping aside because they know they can't hold the price down against the catalysts of the insider buying and the Solana news. The dam broke on Friday. They realized they were on the wrong side and got out of the way.
Or they're stepping aside to let retail bag holders chase the breakout before they re-shorted at 250. That's the cynical but often correct view.
So that brings us to our conclusion. Where do you stand on YYAI right now?
For me, YYAI is a high beta speculation, pure and simple. It's not an investment. The counterparty risk with JuCoin is a deal breaker.
Combine that with negative operating cash flow, and you are betting on a regulatory shortcut in a hostile SEC environment. It's a gamble on whether the SEC strikes before the Solana ETF gets approved. For a conservative portfolio, this is uninvestable.
And I completely disagree. I think the risk is priced in at $1.54. The Zhao put, that $5.77 million insider buy, is the strongest signal you can find. Management is putting their own capital on the line. When you combine that conviction with the short squeeze mechanics, that 54% borrow fee means shorts are feeling incredible pain, and the tailwinds from the Solana ETF probability, you have a perfect storm. The asymmetric upside here, for me, outweighs the structural risks.
It's going to be a wild week, regardless of who is right.
Agreed. Both the poly market odds and the liquidity drying up suggest extreme volatility. Listeners need to watch that 167 resistance level from Friday closely. If it breaks that, we could see a rapid move higher.
And if it rejects at that level, that fragile order book could empty out just as fast.
That's what makes a market.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya!